People say the gold market is in chaos and point at a chart, but the real tremor starts somewhere else. Inside the pipes that turn a quoted price into a bar you can actually take delivery of. In global finance, gold is often described as timeless, an asset that sits outside politics. The market that prices it is anything but. It is a set of institutions and protocols that decide what counts as good, who can trade at scale, and how promises become metal. The difference matters because a price is only as real as the system that can settle it. When that system is trusted, a benchmark looks like an objective number. When it isn't, the benchmark becomes a vote on legitimacy, and the vote can splinter. The modern gold order began long before today's headlines. In 1944, Bretton Woods created a post-war architecture with the US dollar at the center. In 1971, the US ended dollar convertibility into gold, severing the formal monetary link and pushing gold into a new role reserve asset, hedge, and collateral of last resort. In 2008, the global financial crisis taught markets a blunt lesson. Liquidity can vanish, counterparty risk can migrate overnight, and the most valuable feature of any asset is not yield, but transferability. Those three dates don't just explain macro history. They explain why the gold market evolved into a highly engineered system of standards, custody, and settlement. At the top of that system sits a benchmark, a shared reference price that allows banks, refiners, miners, central banks, and manufacturers to, quote, hedge and clear transactions across jurisdictions. The LBMA gold price and LBMA silver price are administered by ICE Benchmark Administration, a detail that sounds bureaucratic until it is read as governance. A benchmark is a legal and operational object, not a crowd opinion. A benchmark's purpose is not to create scarcity or abundance. Its purpose is to synchronize behavior. Without it, every trade becomes a bespoke negotiation. With it, a global market can move quickly so long as the next layer holds. That next layer is custody, where the market's paper becomes physical. Custody is not a metaphor. It is vaulting, chain of title, bar lists, and settlement mechanics. It is the difference between owning a claim that can be netted and owning metal that can be withdrawn. This is why the power center of gold has never been only the place where price is quoted. It has been the place where delivery is easiest to enforce. In practice, the market runs on the assumption that the pipes stay open, that metal can be sourced, transferred, and re-registered when needed, even if most participants never request a pallet of bars. The scale of that assumption can be seen in the custody snapshots published by the London Vaulting Ecosystem. At the end of November 2025, the reported total held in London vaults was roughly 8,907 tons of gold and 27,187 tons of silver. Those numbers should not be treated as a simple inventory in the way a retail investor imagines stock on a shelf. They are better understood as the mass of collateral and settlement capacity that sits behind a web of promises. In a calm regime, that web behaves like lubrication. It reduces friction, tightens spreads, and makes the benchmark feel universal. In a stressed regime, the same concentration becomes a strategic question. If so much settlement gravity clusters around a particular custody and governance stack, what happens when participants begin to distrust access? This is the point where chaos stops being a slogan and becomes a mechanism. The market can tolerate price volatility. It has built decades of hedging tools for that. What it struggles to tolerate is uncertainty about deliverability, uncertainty about whether a price represents a claim that can be honored in metal in a known jurisdiction under a known rulebook. That uncertainty does not need to be total to be consequential. It only needs to be plausible enough that large actors start treating optionality as rational. The system can continue to function and still lose its monopoly power, the way a dominant shipping lane loses relevance when a second canal opens. And the second canal already exists in at least one critical sense: a working physical benchmark outside the traditional Western reference complex. Shanghai's gold benchmark, priced in RMB per gram and grounded in a physical exchange mechanism, demonstrates that a global market can operate with more than one legitimate anchor. This does not mean one benchmark replaces another overnight. It means the concept of a single, uncontested reference price is no longer guaranteed by default. It becomes an outcome that must be maintained. Seen through this lens, dominance is not about asserting that one city sets the price. Dominance is about controlling the conditions that make a price feel final, governance that markets accept, custody that markets trust, and delivery mechanics that markets assume will remain neutral. When those conditions hold, participants can pretend politics is irrelevant. When those conditions are challenged, politics re-enters through the side door through compliance, standards, and permissioning, because that is where the real choke points live. This chapter's conclusion is not that the old center has collapsed. It is that the center is definable and therefore vulnerable. Once a market understands that its price is a bundle of rights, rights to access, to settle, to withdraw, to certify, then the battlefield stops being the chart and starts being the rulebook. That is where long-run power shifts happen, quietly, through infrastructure, with the kind of time horizon that headlines cannot measure. So here's the real question. What happens when standards, the tools meant to measure quality, start behaving like political borders? You don't have to bomb a financial system to change it. Sometimes you only need to revoke a passport and watch the supply chain reroute itself. A market built on technical rules only looks apolitical when those rules remain neutral. The moment access becomes conditional, standards stop behaving like measurement tools and start behaving like borders. In precious metals, that border is not a coastline. It is a list, a certification, a permission to be treated as deliverable inside the deepest pools of liquidity. Once that permission is questioned, the market's behavior shifts from optimizing price to managing jurisdictional risk, quietly, mechanically, and at scale. In 2022, the leverage point that mattered most was not a new tax or a dramatic shutdown. It was recognition. When certain refineries lost good delivery standing in the wake of sanctions-era compliance, the consequence was structural. Metal that had been widely fungible within the highest liquidity ecosystem faced friction re-entering it. That is what weaponization by access looks like in practice. It does not need to stop production. It only needs to make the output harder to certify, harder to warehouse with the right counterparties, and harder to settle through the old pipes. This is why the most consequential responses are rarely theatrical, they are architectural. If a system's strongest weapon is the ability to deny access, the rational counter is to reduce dependence on that access, not by arguing inside the gate, but by building another gate. That logic sits underneath the reported proposal for a Moscow-centered alternative, standards and pricing infrastructure, often described as a Moscow world standard. Read as political messaging, it sounds like posturing. Read as systems design, it is a functional blueprint. Replace the old market's core services, standard setting, pricing references, and the institutional scaffolding that makes those references tradable at scale. The key point is that no alternative wins by declaring itself. It wins by performing the same jobs the incumbent performs with enough reliability that others begin routing flows through it during moments of stress. That performance requires more than a trading venue. It requires an end-to-end stack. A viable parallel rail needs 5 layers. A price reference that is published and trusted. Standards. Specifications that define what qualifies. Clearing. Settlement rules that turn trades into finality. Audit. Verification that makes the system defensible to large institutions. And liquidity providers willing to quote two-way markets and warehouse risk. Miss the 5th layer and the system exists only on paper-thin, episodic, and easily ignored. This is why the more interesting developments are the ones that talk about plumbing instead of slogans. Reporting on discussions around an international precious metals exchange framework in a multipolar bloc emphasized the institutional checklist price indicators, standards, clearing, and auditing rather than a single headline-grabbing new currency. Even without assigning motives, the direction is clear. Build enough of the stack that participation becomes operationally plausible, not merely politically desirable. The information environment, however, makes it easy to misread what matters. Viral imagery and symbolic gestures can dominate the conversation, while infrastructure moves quietly underneath. A useful discipline is to separate optics from mechanics. When a widely circulated BRICS banknote image was fact-checked as not an official currency issue, it underscored the point. Markets do not reroute trillions because of props. They reroute when the pipes are rebuilt, when settlement can happen, when verification can be defended, when counterparties can make markets without being trapped by compliance exposure. Seen this way, the phrase destroyed becomes less a claim about a dramatic end state and more a description of a process, the erosion of inevitability. An incumbent system's greatest advantage is not that it is perfect, but that it is default. Weaponized access attacks that default by forcing participants to treat the old route as conditional. Once conditionality enters, diversification becomes rational. Firms and states do not need to declare allegiance to an alternative. They only need to keep one ready and use it when the risk-adjusted cost of relying on the old gate rises. There is a colder implication here. The same tool that creates pressure also creates discipline. By tightening recognition and compliance, the incumbent can make its high liquidity zone more defensible, more auditable, more acceptable to regulated balance sheets. At the same time, it accelerates the search for parallel rails among actors who cannot accept the new conditions. The result is not a single rupture. It is a gradual segmentation, different routes for different participants, governed by different definitions of legitimacy. But infrastructure only becomes real when it survives stress. And 2025 supplied the kind of stress that forces markets to show their true operating limits. Markets don't panic when people feel nervous. Markets panic when metal has to fly because the spread got big enough to justify moving physics across an ocean. By 2025, the gold market wasn't revealing itself through rhetoric. It was revealing itself through freight schedules, warehouse reports, and the sudden relevance of a question most investors never ask. Where is the metal? In what form? Under whose custody? And how fast can it be re-registered for delivery? When those answers become expensive, the market's single global price stops behaving like a law of nature and starts behaving like a temporary equilibrium that can break under policy and positioning. The stress signal in 2025 was the divergence between venues that are often treated as interchangeable. On paper, a futures price and a spot benchmark should stay in tight orbit. In practice, that orbit depends on a pipeline refining, assaying, bar specifications, vault logistics, and the willingness of intermediaries to warehouse the risk that the pipeline might jam. When the gap between New York and London widened enough, it stopped looking like routine arbitrage and started looking like a migration incentive. Metal would physically move to the place where settlement pressure and pricing advantage were strongest. Reuters described the episode as a surge of gold moving from London toward the United States, with inventories in the COMEX system swelling sharply, reportedly about a 126% rise since late 2024, and tens of billions of dollars worth of gold added, while London's pool thinned and OTC liquidity grew more brittle. The number is not important because it proves scarcity in the abstract. It matters because it proves that the market was willing to pay the full cost of relocating metal simply to secure deliverability in the preferred venue. That is a structural symptom, not a sentiment indicator. This is where the pipes become visible. Gold is not a uniform product. Delivery rules specify bar sizes, acceptable refiners, chain of custody documentation, and the custody regimes that large institutions can use without triggering compliance concerns. When spreads widen, the theoretical trade buy in one place, sell in another becomes a practical problem. The bar in the wrong vault is not the same as the bar in the right vault. The cost of that mismatch is paid in time, insurance, security, and ultimately in the price difference itself. In a calm regime, that machinery is background noise. In a stress regime, it becomes the market. The second stress marker was the appearance of a boundary between private liquidity and institutional backstops. Reuters reporting tied the drawdown in London's readily available liquidity to increased reliance on lending mechanisms that can stabilize short-term delivery pressures. That detail matters because it distinguishes normal volatility from plumbing stress. A market can handle strong opinions. It struggles when the mechanics of settlement begin to require emergency oxygen. When a backstop becomes relevant, the system is not necessarily failing, but it is confessing that it has limits, and that those limits are reached through the physical layer, not the price quote. Financial Times coverage added texture to the same story. Short-term gold borrowing costs in London spiked during the dislocation, and participants reported delays and frictions around withdrawing gold from official custody, forcing more metal to be sourced elsewhere or financed at uncomfortable rates. Again, the analytical point is not that the market ran out of gold. The point is that specific pools of deliverable gold in specific custody regimes became difficult enough to access that the market began paying a premium for location and immediacy. That is how a price becomes a delivery right in real time. The third stress marker was how quickly policy could manufacture and then unwind the dislocation. In 2025, the spread between New York and London was not only a product of demand for metal, it was also a product of regulatory and trade policy uncertainty. When the U.S. clarified that precious metals would be excluded from new tariffs, the premium narrowed sharply. That is the signature of a policy-driven distortion. The market reprices not because geology changed, but because the risk of moving the metal through a particular channel changed. In other words, chaos was partly a function of rulebooks, not just inventories. This is the part that tends to get lost in simplified narratives. A stress test does not have to end in default to change behavior. It only has to demonstrate that under certain conditions, spread widening, compliance, uncertainty, custody friction, the market will reroute in bulk and at speed. Every time that happens, two things become more visible. First, that settlement is concentrated and therefore vulnerable to bottlenecks. Second, that alternate routing paths have value even if they are used only in emergencies. The market learns, and the learning accumulates. A brief reinforcement appeared in silver during the same year. Reuters described a squeeze in London that later eased after large inflows, underscoring that the same mechanics, location, premiums, delivery pressure, and inventory migration can surface across metals without producing a headline collapse. The lesson is not that gold and silver are identical. The lesson is that when the system is stressed, the physical layer behaves like a common fault line. By the end of the 2025 episode, the market had produced an evidence file that no ideological argument could match. Large inventory movements, measurable spread dynamics, signs of reliance on backstop liquidity, and an abrupt repricing when policy constraints were removed. Together, those signals describe a regime in transition, not a demolition, not a clean break, but a shift from a world where settlement routes are assumed to be neutral to a world where settlement routes are treated as contingent and therefore worth diversifying. After 2025, the real question stops being who destroyed whom. It becomes how many rails can exist at once and what happens when legitimacy itself becomes a priced commodity. Empires rarely fall with a single headline. In finance, they fade when the world quietly learns it has another way to settle the same transaction without asking permission. The 2025 stress episode did not prove that any one hub was empty or finished. It proved something more actionable. Settlement is a routing problem. When routing becomes conditional on policy, on compliance, on custody friction, large players stop treating the incumbent route as a law of nature and start treating it as one path among several. That mindset shift is the real turning point because it changes what institutions optimize for. They stop optimizing for the best quote and start optimizing for guaranteed finality under the most predictable rulebook. This is where the word destroyed needs to be translated into systems language. A monopoly in market structure does not end only when it collapses. It ends when it becomes optional, when enough credible counterparties can choose an alternate route and still obtain a price, a standard, and settlement they can defend to boards, auditors, and regulators. Optionality is not a mood, it is an operational capability. In practice, it is built, not declared. A parallel rail that matters must solve the same jobs the incumbent rail solves, end to end, under stress. The minimum viable blueprint has 5 layers. First, a price reference that can be published consistently and accepted by large institutions. Second, standards and specifications that define what is deliverable in that system, what bar forms, what refiners, what documentation. Third, clearing and settlement rules that turn trades into finality rather than a chain of open obligations. Fourth, audit and verification that make the system legible and defensible to outsiders. And fifth, liquidity providers that quote two-way markets, warehouse inventory risk, and keep the rail usable when volatility is high. Without the fifth layer, a venue can exist and still fail to attract real flows because price discovery without balance sheet capacity collapses into sporadic transactions and wide spreads. What makes the current transition noteworthy is that pieces of this stack are being discussed in public, in institutional terms, rather than as ideology. Reporting around conversations on an international precious metals exchange framework emphasized the architecture. Price indicators, standards, clearing, and auditing 4 of the 5 layers in plain sight. That does not confirm a finished rival system. It confirms design intent focused on functionality. And in market structure, intent matters when it is expressed as governance, not as slogans. At the same time, the argument that multipolar pricing is impossible has already been disproven by operations. Shanghai's physical benchmark priced in RMB per gram demonstrates that an alternative reference point can function in real markets, in real time, with real participation. This does not automatically dethrone London or New York. It does something subtler. It normalizes the idea that a benchmark can exist outside the incumbent complex and still be used as an anchor. Once that normalization exists, a future rail does not need to convince the world to accept a new concept. It only needs to expand an already familiar one. The long-game twist becomes clearer here. The actors portrayed as challengers do not need to win by forcing an immediate repricing event. They can win by reducing their own exposure to gatekeeping, one layer at a time. A reported proposal like the Moscow World Standard can be read as a response to a specific problem. If the old system can deny recognition, the rational counter is to build recognition elsewhere, with standards that do not depend on an external list. Whether any single proposal succeeds is less important than what the proposals reveal. The strategic objective is to make settlement survivable under political constraint, That objective naturally pulls toward the five-layer build. None of this guarantees that the incumbent loses relevance. The incumbent rail still possesses immense advantages: depth, established counterparties, and a history of accepted governance. But those advantages become less absolute once the market has seen that deliverability can depend on policy and access. After that realization, even institutions that remain committed to the incumbent have a rational incentive to support redundancy. In that environment, a parallel rail does not need to replace the old rail to weaken its monopoly power. It only needs to be credible enough to be used occasionally, because occasional use is how new liquidity habits form. The most important change, then, is not a sudden migration of all flows. It is a change in what counts as safe settlement. In a single rail world, safety is assumed. In a multi-rail world, safety is compared. Participants begin asking new questions before they trade. Which rulebook is least likely to change midstream? Which custody regime is least likely to become constrained? Which standard can be defended across jurisdictions? And which market makers are willing to stand in the middle when headlines hit? Those questions reshape behavior even when prices are calm, because they reshape where balance sheets are willing to commit. By the end of this chapter, the definition of destroyed is deliberately narrow and cold. A pricing center dies the moment it becomes optional, not irrelevant optional. But optionality creates a new battleground. When multiple rails exist, the fight shifts from price to legitimacy, and legitimacy is enforced through data, provenance, and compliance. In a multipolar market, the hardest question isn't what's the price? It's is this bar acceptable, and who gets to answer that at scale? Once pricing becomes optional, the center of gravity moves again. The battle is no longer only over where trades can be routed. It is over which metal is treated as interchangeable inside the deepest pools of liquidity. In practical terms, acceptability becomes a second price axis. The market starts quoting not just for gold, but for gold that can travel cleanly across jurisdictions, balance sheets, and compliance departments without triggering a fight over provenance. This is where transparency stops being a slogan and becomes infrastructure. For a large institution, the risk is rarely that a bar contains less gold than it should. The risk is that a bar becomes hard to finance, hard to transfer, or hard to settle because its chain of custody cannot be defended when rules tighten. In a sanctions and compliance-sensitive world, that is not a moral judgment. It is a constraint that dictates where liquidity will gather. Because regulated capital cannot live comfortably in ambiguity, the incumbent ecosystem has an obvious incentive to harden that constraint into an advantage. If a pricing regime can no longer rely on inevitability, it can still defend its position by making its high liquidity zone the safest place for regulated institutions to operate. That defense is built with data. Standardized records of bars, refiners, and supply chain integrity that allow counterparties to underwrite transferability, not merely ownership. The clearest expression of this shift is the move toward structured provenance systems, such as the LBMA's Gold Bar Integrity Database. The timeline matters because it shows intent to operationalize legitimacy, not just discuss it. The database was launched in 2025, with reporting requirements ramping during 2026 and mandatory expectations set for 2027. This is not a footnote. It is a statement about where the incumbent believes power is moving. If market participants increasingly fear that access and recognition can be tightened, then the rational countermove is to define legitimacy with enough precision that liquidity can remain concentrated where the definition is accepted. What does that change in day-to-day terms? It turns provenance into a tradable feature. A bar with clean, verifiable documentation is easier to finance, easier to pledge as collateral, easier to transfer between major custodians, and easier to accept without widening spreads. A bar with gaps, unclear origin, disputed chain of custody, or documentation that a major counterparty cannot rely on does not stop being gold, but it can stop being frictionless gold. That difference shows up as time, paperwork, higher haircuts, fewer willing market makers, and wider effective bid-ask spreads. This is how a tiered market forms without a dramatic rupture. Tier A is metal that meets the prevailing legitimacy standard and therefore enjoys the most efficient liquidity. Tier B is metal that is still valuable but lives in a more conditional environment, one where counterparties demand a premium for taking compliance risk, or where the metal trades at a discount because fewer balance sheets are willing to intermediate it at scale. The key is that the tiers can exist even if the headline price is stable, because the tiers are created by transferability and acceptance, not by geology. There is a strategic asymmetry embedded in this dynamic. The incumbent system can present traceability as prudential governance, and it is, in part, Exactly that. But governance has side effects. Once legitimacy is codified, it can be tightened. Once it can be tightened, it can be used to segment who gets the best liquidity and who doesn't. That segmentation does not require overt political language. It can be implemented as technical compliance and therefore defended as market integrity even while it functions as a filter. This is why the data layer becomes the new fence in a multipolar environment. Parallel settlement paths may exist, and participants may root around choke points when they must, but scaling any alternative requires its own legitimacy regime, its own way to prove bars are what they claim to be and acceptable to the institutions providing liquidity. Without that, alternative rails may handle episodic flows, yet struggle to capture the deepest pools where tight spreads and large size are possible. The result is not a single global market breaking in half overnight. It is a market learning to price the same metal differently depending on the certainty of its status. That is the quiet mechanism by which the incumbent can remain powerful, even as monopoly pricing erodes. It shifts from controlling the number on the screen to controlling the conditions under which the best number is available. The headline debate stays focused on who sets the price. The real contest is over who sets the definition of good, in a world where good increasingly means unquestionably transferable. If legitimacy can be priced, then the global gold price becomes a family of prices. And that raises the final question. What does the new order look like when multiple rails and multiple tiers coexist? Everyone waits for the day the old system breaks. The more common ending is quieter. The world simply stops agreeing on a single definition of settlement, legitimacy, and price. By the time a headline declares that a market has been destroyed, the real transition is usually already underway. Dominance in global finance rarely ends because an institution disappears. It ends because the privileges that once felt automatic universal acceptance, frictionless transfer, predictable settlement become conditional, and participants respond by building redundancy. In that world, the old center can remain large, sophisticated, and active. What changes is that it no longer owns the only narrative that matters, the narrative of finality. This is why the most useful way to read the current gold story is not as a dramatic overthrow, but as a structural drift. Pricing becomes multipolar when multiple reference points can be used without breaking the chain of settlement. Settlement becomes multipolar when credible rails exist beyond a single jurisdictional choke point. And legitimacy becomes multipolar when acceptability can be proven under more than one rulebook. None of these shifts require a crash. They only require that the market begins to treat one global price as an assumption that must be maintained, not a constant that can be taken for granted. Zooming out, the macro backdrop supports the idea that large actors are paying for insurance against conditionality. The IMF's COFR data puts the U.S. dollar at about 57.8% of global allocated foreign exchange reserves at the end of 2024, still dominant, but lower than past decades, and a reminder that reserve structures can evolve without a single rupture. The World Gold Council reports net central bank gold purchases of 1,037 tons in 2023, consistent with institutions choosing resilience over elegance in an era where access and settlement can be politicized. The point is not that one regime is about to vanish. The point is that the world is quietly spending balance sheet capacity to reduce dependence on any single gate. That same logic explains why governance becomes a competitive arena. When a market's pricing monopoly weakens, incumbents do not merely defend the number. They defend the conditions under which the best liquidity is available. Provenance systems and integrity databases are part of that defense, because legitimacy is what keeps deep pools deep. The timeline matters not as a bureaucratic schedule, but as an intent signal. The market is formalizing what counts as transferable, financeable, and acceptable because those attributes are the true scarce resources when geopolitical risk rises. From here, the future does not need one prophecy. It needs scenario logic. One path is managed multipolarity. Rails proliferate, but governance and transparency keep fragmentation contained, so prices stay tightly linked even if settlement routes diversify. Another path is permanent fragmentation. Legitimacy standards diverge enough that liquidity clusters by regime, producing multiple effective prices for the same metal, depending on where and how it can be financed and delivered. The third path is a policy-triggered repricing. A sudden change in trade rules, compliance constraints, or settlement access forces institutions to reroute at speed, accelerating multipolarity in months instead of years. The mechanisms differ, but the pattern is consistent. Power shifts toward whoever can offer predictable finality under stress. The practical implication for a global audience is not to memorize slogans, but to watch the system's quiet indicators. When cross-venue premia persist, the market is pricing routing risk. When vault snapshots show sustained directional flows, the market is reallocating settlement gravity. When integrity standards tighten or reporting requirements change, the market is redefining what qualifies for high liquidity treatment. When alternative frameworks progress from speeches to standards, clearing, auditing, and market-making capacity, the market is building a second set of pipes. And when central banks continue accumulating gold through cycles, they are signaling that system insurance remains cheaper than system regret. In that sense, the verdict on destroyed is deliberately unemotional. The incumbent gold complex does not need to implode to lose monopoly power. It only needs to become one option among several, in a world that has learned to price access, documentation, and settlement certainty as much as it prices metal itself. History doesn't repeat randomly, it repeats through infrastructure. And if you can't see the rails, if you only see the headline, you don't get punished by ideology. You get punished by liquidity. We're entering a phase where price is no longer a single number, but the outcome of settlement rails, eligibility standards, and the credibility of delivery, an early sign that the system is changing shape. History is blunt on this point. When a dominant financial regime weaponizes access freezing participation, narrowing standards, turning plumbing into leverage, it doesn't eliminate rivals. It incentivizes them to build parallel infrastructure and slowly erodes the monopoly it once took for granted. Much like sterling's long fade as Britain's global commitments outgrew the system it could underwrite, today's order is being tested by the cost of enforcing compliance through the very networks that created its power. In a multipolar world, the winner isn't the loudest storyteller, it's whoever builds the most complete architecture for pricing, clearing, auditing, and liquidity when stress returns. The memorable rule is simple. Financial hegemony doesn't end with a bang, it ends when the world has another rail it can trust.